Leverage trading is one of the fastest ways to make a ton of money and also one of the fastest ways to lose a lot of money if you don't know what you're doing. And in this video with Coin Bureau Trading, I'm going to be talking about leverage trading. I'm going to give you an incredible Google sheet that you can use so that way you can have a little bit of a reality check when it comes to using leverage. And I'm going to be sharing one of the best non-KYC derivatives exchanges that you've probably never heard of before, but the links have been in my description for quite a while. And that exchange is CoinCatch. CoinCatch is a non-KYC derivatives exchange available to people that are in Canada and the United States. A lot of you watching this channel are from those locations. How do they get away with this? Is this actually illegal? Are they going through some back door? No, it's actually a legal thing that many new exchanges are doing. Now, here's the truth. A lot of the bigger exchanges that you already know, love, and probably use have been formed well before a lot of these new laws in the North American region rather, have established. So the problem that a lot of these older exchanges have is that it's going to take them a lot more time to set up and rebuild and restructure their companies, whereas new exchanges like CoinCatch can do it real quick and do it the right way. So what does a non-KYC exchange mean? Well, it means you don't have to take one of those selfie photos. You don't have to show them where you live. You don't have to show proof of address. You can actually deposit funds and you can withdraw up to $50,000 being completely unknown. Sounds pretty good, right, Anon? So how do they do this? Well, they do this by going through the right methods. They're registered with Fintrac in Canada and FinCEN in the United States. Now, they do also boast a ridiculous 200x max leverage for Bitcoin and 150x leverage for Ethereum. Now, before I start talking about that, please understand that in no way, shape, or form am I advocating for that whatsoever. I actually want to share with you some responsible takes and the realities of going long and short when it comes to using futures. But before I do, you know what to do. Like the video, and if you haven't subscribed already to this channel, subscribe. There is a ton of fantastic content that we have planned for you this year, and CoinCatch, this review is going to blow your mind. But first, we need to start with a couple of key words, phrases, terms, things you gotta understand when it comes to leverage trading before I show you how to open up a juicy trade like this that is over $500 in profit right now on my live account. So I'm gonna get to this in a second. There's a couple of really unique and cool things about using CoinCatch that I'll show you, but first we need to talk about this. Now, the main thing you need to know about this sheet is that I have taken all of these percentages from this anti-liquidation tool that I've been using for over 5 years. It's been very reliable as a source of information, but the main thing you're going to notice is that the change in price to liquidation, these are the percentages that you see here. Change in price until liquidation. You'll notice that for a long, you would think that 2 times liquidation, you're going to be liquidated at 50%. I actually think it's better to have this number in mind. Why, oh why do you want to inch as close as you possibly can to liquidation? It makes no sense to me. And let's demystify what is liquidation. Well, it's as simple as this. I have $100. I want to say to you, the exchange, well, I'm going to give you this $100 and you're going to give me $1,000 back. So my $100 is essentially a loan, or it's a representation of the margin. And I'm giving this to you and you're going to loan me $1,000 to trade with. So now I have $1,000, which is amazing. So the problem is that when the price goes against me so that my margin is basically equal to my loss, the exchange says, oh, thank you so much for your margin. We're keeping it. Bye-bye. Thanks for playing. See you next time. That's it. So all those liquidation events that we have, all those ridiculously terrible market disasters and catastrophes and dumps where the prices shoot down 50% in a day, that causes a lot of people using leverage to be liquidated. Is there a way to get around liquidation? Yes, there actually is. And it's not going to be the thing that you're going to want to say out loud. It's like the boogeyman. You're not going to want to say it, but it's really, well, the boogeyman's not going to help you in a bad situation, but you get the idea. The idea of how you protect your portfolio is coming up when I share the chart. But I want to get into something here that makes a lot of sense, but will probably confuse you, okay? Now, if I were to put in a position of $100, my margin, I'm lending it to the exchange, I want to use 10 times that leverage. Well, that means that I'm playing with $1,000. If the price goes up 10%, then that means my actual return on investment is going to be 100%. I put in $100 with 10x leverage, goes up 10%, I actually earn just shy of that $100 investment. Why? because there are fees, just like any other trading fee, whether you're on the spot market or the futures markets or whatever, there's always going to be a fee. These fees are actually pretty cheap compared to many of the other bigger exchanges too, might I add. So here's the thing. Yes, you can make good money. Yes, you can earn 100% or more on a trade. It's not uncommon to do that in crypto. But the size, the margin matters. And the more leverage you use, you can make a whole lot more money. Yes, I could use 50x leverage with $100 of margin. Price goes up 10%. Wow, I just made a 5x. Well, good grief. Why don't I just use 100x on every single trade with $100? Because I could always make a 10x with 10%. First off, this is obviously wrong and errant in so many ways, because is it really realistic to demand returns from the market every single time? Nope. Nope. The market's going to do whatever it's going to do, no matter how amazing your indicators are, your drawings are, who's in office, what bullish narratives are happening. The market can do whatever it wants to do. So while you could make 10x with leverage, while you could make 100x with leverage, there's no guarantee of doing that. And that's really not the purpose of leverage. The real purpose of leverage is actually to buoy your account. So let's actually transition to the other side of this, which is perfect because we're only talking about longs. The benefit of using leverage is that we can say, well, I only have $100 worth of Bitcoin, and I want to make sure that my Bitcoin is actually going to be worth the same amount. So if I'm expecting the price of Bitcoin to fall 10%, instead of me selling my Bitcoin, I can actually still hold my Bitcoin, and I can use an equivalent amount of USDT or stablecoins or whatever you want, give it to the exchange and say, I want to borrow against my Bitcoin because I think the price is going down. And when the price goes against me, when the price actually falls, I actually earn a profit. So the real reason why futures trading exists is to actually hedge your portfolio. It's not to go irresponsibly long all the time. There are actually many positive benefits to using leverage, but it's not going 100x long all the time, despite how funny and entertaining the memes are, despite how incredible and mind-blowing the screenshots can be of people making 350,000% on a trade. The reality, though, is that leverage trading really exists. It initially exists with the primary focus of hedging your portfolio against drawdown. So in the upcoming bear market, after you made all of these amazing gains from this top year, this bull market year, you can open up a leveraged short that doesn't have to be incredible like 100x short, but you can preserve your portfolio's amounts. You can still hold on to Bitcoin, Ethereum, XRP, Pepe, whatever you want, and open up a short so that when the prices go down, you're actually earning money as the price falls lower. Make sense? That's the real intention. I also want to draw to your attention too that there is a drastic difference between long and short. Now, I'm going to make this the same so that way you can see it a bit more clearly. When I'm using 10x leverage for a long position, my liquidation price or percentage, again, this is going off of a resource that I've been using for years, and I'm not going to change it for lots of good reasons. My liquidation price is going to be about negative 33% below my price. But if I'm shorting the market, it's actually going to be 99% above the price. So I could actually open up a leveraged short on Bitcoin because I don't believe it's going to go above 188,000. Well, let's say I don't believe it's going to do that this time around, right? The benefit of doing this is that, again, I can take my margin, multiply the size, go against the market, and I actually have way more wiggle room. Now, why is there a dramatic difference in the liquidation prices for a long versus a short? This is easy to understand, but a lot of people didn't understand this initially. Here's the thing. How high can markets go? Literally, the sky is the limit. Some charts this time around, they're going to pull 20x, 50x, maybe even 100x, going up 10,000%. But how low can charts go? Negative 99.99%. I'm looking at you, Terra Luna. So the reality is that charts can only drop a maximum of 99%, but they could go up an unlimited amount. Therefore, going back to the sheet, it's actually safer to short the market because there is, to the exchanges side of this, there's less risk of them losing money compared to a long. The reason why the liquidation price is so tight for a long is because they have more to lose as the lender, okay? Now, they will still make money on fees. They'll still make money on you if you happen to get liquidated or you have a stop loss trigger, okay? That will happen. But the main thing to understand is that from the exchange's side, from the lender's side, they are actually at less risk offering you money in return for a short on the market. So it's actually cheaper, it's safer to short the market. Now, I'm saying this with air quotes because we all know Bitcoin continues to go up higher and higher and higher. So you could still have opened up a 2 times leverage short at $20,000. You would have been liquidated eventually, right? So the whole point of leverage trading as well is that you don't keep one of these positions open forever. Leverage trading is really meant to be done in a short amount of time. It's not meant to be this, I'm holding a position open that's leveraged for the next year and a half. Some people do that. Did you hear that? Do it? I know, so immature. But the problem with that are fees, and a lot of people don't think about this. Now let's look at the position I have open right now on CoinCatch. This is a TIA long 10x leverage. So the reality is that right now, I've actually realized a loss. Wait, hold on. It says that I'm in profit $553, and that's going to fluctuate up and down. But how did I realize a loss right now? Well, that's easy because in my 10x position, I'm actually accumulating fees to hold this open. There's this really simple concept to understand in that longs are paying shorts and shorts are paying longs dependent on the chart. So if the price is going up, it's actually more expensive, as you can see here by this realized P&L of negative $12. It's more expensive to hold a long position open. Now, if the price is going down and I have a short, it's more expensive because the price is going in my favor. So exchanges have these funding rates set up in place to basically help them to earn some money against you. I know this is supposed to be such a positive video on leverage trading, but I'm doing it my way. And as much as I do enjoy using CoinCatch, as much as I am pro CoinCatch, and the links again to sign up are down below for all the benefits they have, they're still a business and you are the one providing them with the income and the revenue. Let's be real. So you're not going to see anyone else tell you this, by the way, on an exchange review video, but this is the real deal. And I told them I was going to do this video my way. All right. So Frankie would be proud, right? Sinatra would be so proud. Now, here's the reality of this trade. If I were to close it right now, I would be up $532 minus the fees, which is actually a pretty amazing trade, making about $500, well, a little bit over $500 in about 4 days' time. But the reality is that this could easily just as well go against me. Okay, so understand that leverage trading may be a quick way to make a buck, but it's also a quick way to lose a lot of bucks if you're not careful. So let's talk about a couple of these things that we can use to protect ourselves, namely a stop loss. Now you'll see here on this open position that I have for TIA, and by the way, the reason that I open this is because of this juicy signal that I saw here on Friday. This gave me confidence to open up the position. And I'm also looking at the 4-hour time frame, looking at this going, that also looks really good too. Now, it could take a while for TIA to hit my targets, but understand that I am not just blindly going into any of these trades. I'm spending a lot of time to figure out when is the right time, and then I will inevitably be wrong at some point. So I'm not trying to say like, look at me, I'm so amazing, I'm making so much money leverage trading. The reality is that I've also lost a lot of money leverage trading. But the way that I stay in the game is this fancy little word right here, stop loss. Now, before all of you just click off, I need you to hear me. Stop losses are not a bad thing in futures trading. You need a stop loss in futures because if you don't, you might as well just donate your money to some worthy organization to get a tax write-off or just to be a good Samaritan because you are basically kissing your portfolio goodbye. You need to use a stop loss when it comes to futures trading because if you don't, then what point do you have as a trader? What are you even doing here? You should not be doing this. And the reason why is because if you don't have a portfolio, you have nothing to trade with. You're not a trader anymore. You're just an employee of McDonald's. So understand that you've got to use a stop loss. Now, admittedly, everyone's going to have their own ideas and theories about stop losses and how to use them. But you can see here with this trade setup, I like to use a 3-to-1 ratio. So it says risk to reward ratio 3.02. My stop loss was originally down here, and I actually want to show you how to change that. So I have an open position right here. I'm going to click on this guy, and unfortunately I can't see the price anymore, but here is where I can change my stop loss. I'm going to go on edit right here, and I want to change this. So one thing that they don't let you do is they don't let you put this up into the profit zone. And the profit zone, to show you over here on TradingView, because it's a little bit easier, let's say that I have, let me delete this. So I'm in profit about 4% on my position, something like that, right? Great, so I'm in profit right here. If I had my stop loss down here, preparing myself to lose quite a bit, 6% times 10, so 60% of this position, it would be quite the loss. I want to protect my portfolio just in case. So while I do have a desire to take profit a lot higher, yes, I am writing a children's novel, a short novel, novella, maybe a stenograph. But I'm going to be writing, no, just kidding. I'm going to be protecting my portfolio at all costs. And that means putting a stop loss into the safety, or rather into the profit zone. Because even if the price happens to go up after hitting my stop loss, I would much rather be closed out in profit instead of a loss. So I'm going to put my stop loss in my profit zone. And those sounds a little bit weird saying it out loud now that I say it over and over. But you can see, here's my entry. I want to put my buy, there we go. My buy is right there at 457. I'm going to put my stop loss just above at 46224. And again, with the sole reason that I want to walk away from this trade in the profit zone, 4.6224. So it says right here, I'm going to be closing at 11%. If I hit confirm, here we go, close this, and we'll see that the sell order right here, let me hide this for a second. I'm going to delete it. So here's my buy. Here's my stop loss. It's actually 1% in the profit zone. So if the price of TIA happens to come down, it's going to close my position in a profit instead of at a loss. This is a great way not to give back your gains. And the reality is that if I close this trade out with $1,000, cool, I made money. If I close it out with $1, cool, I made money. But the way I like to think about this is really, really simple. Would I rather walk away from this trade with $100, where I can make a potential of $10,000, or negative $100? Would you rather walk away from this trade with $1 or lose $1? If you say I would rather lose $1 than gain $1, then you're in the wrong industry, friend. You want to protect your portfolio at all costs. And even though this stop loss might get triggered, it's much safer to me to get this position closed in profit rather than hold open for this Hail Mary price way up here. But with that said, you can set up multiple targets. You can say, well, I want to play with this. I want to have a lot of different orders. I want to have a lot of them spread out just like you can with other exchanges. But there's one interesting thing that I really like about CoinCatch that I haven't seen done on other exchanges. I'm going to go back to this stop loss order as well to show you what I'm talking about, okay? So you can see here, the stop loss is going to be at 11%, but it says BBO. BBO, what's BBO? BBO stands for Best Bid Offer, also known as the Best Buy Price. It's a type of limit order. Now, let's go back to our sheet. We can positively or negatively impact our profit potential depending on the fees. The difference between a maker fee and a taker fee is quite simple. Maker essentially is a limit order. Taker is a market order. Sometimes we need to market sell or market buy depending on the market conditions, but in reality, we want to avoid that at all costs because we actually get a better deal using a limit order compared to a market order. Market orders will always cost us more in the end. We're giving more to the exchange with the desire of putting our order right to the front of the order book. So what's so great about this BBO? Essentially what this is it allows us to automatically place the order as soon as the trigger price is hit on the order book. Let me show you. Okay, so this is our order book right here. The current price is $479.52. Okay, now down here we see the highest bid and the lowest ask. The benefit of this BBO is that when we use this, we have counterparty 1, counterparty 5, Q1, Q5. This is easy to understand once you finally crack the code because it took me a bit, I'm not going to lie. So if I'm going long, Q1 means it's going to put my order the very, very, very tip top of the order book. It's not a market order, but it's going to put it right there. So if I do Q5, it's going to put it 5th in line in the order book. Vice versa, if it's counterparty 1 and I'm trying to short the market, well, I'm going to be shorting it at this level, and my next order to sell will be up here, 5 up at the top of the queue. Now, the same thing works for taking profit, which is going to bring me back to this. So with this example of a stop loss, there is a trigger price, but there's an execution price. And the execution price as such is using this BBO, best bid offer. So that way, if the price goes against me and it closes it in profit, as soon as the trigger price is hit, it's going to place my order right at the top of the queue. So that way, it's going to close it in profit for me. Does that make sense? And it's not going to be executed as a market order. So therefore, I save a little bit of money on this position. As I've been talking to you and filming this video, I also want you to see how much the profit potential has changed. Over the last 10 minutes, it was at $560. Now it's at $460. I want to give you a good word of advice. Leverage trading is not meant for you to just be staring at the screen. It's a good way to give yourself a heart attack and also for you to make a bad decision way too early, way too quickly. When you're using leverage, it's much better to zoom out, to look at the trend, to identify, okay, this could be a good entry, accept a loss if it happens, but also stick to your trading plan. My trading plan hasn't changed, even though the price went up about 12%. And it's like, oh, it would have been nice to get that 12% on my trade because that's 120% on the amount that I put up, right? And yes, it would be amazing to see this happen, but this is my trading plan. If the price goes against me and I get my stop loss triggered, oh well, I still walk away with $100 in my pocket. The main thing you need to know about CoinCatch is that it's a fantastic non-KYC exchange. And the best thing about it is that there is a sign-up bonus that we have through Coin Bureau Trading. So I have a special link down below that brings you to this exact page where you can get $150 sign-up bonus. There are different tiers that you can earn based off of your trading activity month to month. So there's a lot of fantastic other bonuses and other things and offers that CoinCatch has. So you got to sign up with the specific link that's shared down below so that way you could take advantage of this. Now, I want to wrap up this video again, letting you know that leverage trading is a fantastic way to make a ton of money really fast and also lose a lot of money really fast if you do not take proper risk to reward considerations in advance. Understand that stop losses are required when it comes to leverage trading. As much as you don't want to hear that, if you don't have a portfolio to trade with, you're not a trader anymore. You're working at McDonald's. Also understand that you have access to that Google Sheet. Even though the percentages might not be to what you think they should be, this is a much better way to look at it, where things are a lot tighter, so that way you're more conservative. When it comes to opening up positions, I do not suggest going above 10x leverage. I know a lot of you degens can't wait to get your hands on 200x leverage. Not the best idea for long-term returns or performance because crypto is so volatile. And there are also lots of other things that I didn't even get a chance to talk about and discuss in regards to CoinCatch, and that all of that is written in the review. Again, that is linked in the description of this video down below. But the main thing you need to know, CoinCatch is a fantastic non-KYC cryptocurrency exchange that you can trade both spot and futures or derivatives markets and withdraw up to $50,000 per day. So for all of you that have been landlocked by the United States, basically, or North America, and you haven't had access to good leverage trading, check out CoinCatch. And let me know what you all think of this video. This is my first time doing an exchange review, but I also wanted to bring in an educational element to it. So let me know what you think of this video down below. And until the next time, you know what to do. Stay awesome and stay in the green. Peace.